Welcome to this edition of Business Redefined. We have been covering capital markets quite extensively. Last week, we took a deep dive into the first ever share buyback in this region by Nation Media Group, looking at the salient issues. And we want to continue with this conversation on capital markets, and we are privileged to have Dr. Evan Osano, the Director of Capital Markets at FSD Africa. Welcome on set, sir.
Thank you very much.
Dr. Evans, let's start with what has been hot in the markets this week. EABL has gone to the market with a debt issuance, seeking 11 billion at 12.25%, 5-year tenor. And many are having this conversation, is the corporate bond market in Kenya back? And of course, the context here is that ever since what happened with Chase and Imperial happened, we didn't have issuances. Is it back?
It's getting back. I think if you look at the last 4 years, we have not had an issue of a corporate bond. I think Econ was the first after that drought. And now we've seen a few issues coming to the market. But still, when you look at the outstanding, it's about $200 million outstanding at the moment. And this market was much bigger at some point. We had more than $1 billion outstanding of corporate issues. But I'm happy that we have now seen a number of corporates coming back to the market, and I believe it will continue to grow from where it is at the moment.
One of the issues which has been raised with me whenever we have this conversation is that what happened with Chase and Imperial was an indication that the market was not adequately pricing in the risk in the corporate bond side. Is that a view you share?
No, I actually don't share that view as such. If you look at the pricing of those corporates that came to the market, they were priced quite significantly above the sovereign yield at that point in time. I think the challenge was that investors were not able to differentiate different risks. So they were pricing all corporates at the same kind of risk premium, and that I think was the problem.
I see. So when you look at our bond market still, there's still a heavy concentration by government securities. And the question we're always asked is, what will it take to be able to crowd in a lot more corporates to come and tap into the opportunity of raising capital through the capital markets?
And that's an excellent question, and I think it's something that we should all be thinking of how to solve. So if you look at the capital markets in Kenya, $35.2 billion is issuances by government bonds. The equity market is just about $21.4 billion, and the corporate bond market, as we spoke, is $200 million. So there's a big skew towards government, and one of the challenges I think investors face is that the government is offering relatively high and attractive yields, and therefore the opportunity cost for diversifying away from government securities into the corporate securities is much steeper.
I see. So speaking from now the yield perspective, because the government is giving very attractive yields, and that explains why many corporates will shy away because they can't issue the premium. What can we do from the government side? Because we've had a conversation around fiscal consolidation for the longest while. I'm not sure we're successful around it. But what can we do to try and bring down that yield curve?
So there are a number of things that you can do to bring down the yield curve. One of the things that you can also do to bring down the yield curve is by improving the liquidity in the secondary market. So if investors know if I buy a bond today, I can be able to sell it easily without incurring a lot of costs and losing value the following day or the following week, they will be encouraged. So you can actually crowd in more investors into the market. And then in addition to that, when investors buy securities that are not generally very liquid, they put in a liquidity premium which can be very high. So if you reduce that premium by having more tradable securities in the market, you'll actually reduce the cost of raising money in the market, so bringing down the yield curve. So that's one thing that can be done. Another thing that could also be done, of course, is encouraging more investor diversification. So right now we are looking at a pool of Kenyan-based investors. But if you encouraged international investors to come and invest in Kenyan issued securities in local currency, you're going to increase more competition in the market, and that will drive yields down, as we have seen in many markets. So those are some of the things that you can be able to do that. And then, of course, we hope that over time, the government will move towards a path of more physical consolidation so that they do not issue too much securities in the market, which, of course, creates challenges from a pricing perspective.
In June this year, when the World Bank extended an 80 billion shillings facility to Kenya, I was looking at the terms, and one of the conditions was that Kenya needs to work towards developing benchmark bonds to try and strengthen the fixed income market. Many of us still don't understand what that exactly means. Shed some light for us.
So benchmark bonds are basically bonds that are issued at relatively fixed sort of tenor. So 1 year, maybe 3 years, 5 years, 10 years, 15 years, like that. So every time the government comes to the market, they'll be issuing those kind of tenors. But also it means that every time they come to the market, they don't come up with a new issue in the market. They try to reopen existing issues. So they improve the size of the issues that are outstanding in the market. So then you move from a situation where you have over 60 small bonds outstanding to a situation where you have maybe less than 20 bonds outstanding in the market. So they'll be relatively large and benchmark, and that kind of encourages liquidity in those securities. And of course, that reduces the cost of raising capital in the market, as we said before.
One of the game-changing developments in this market, and I think across the globe, was Akiba. Trying to open the bond market to the retail population, and that is just every other person, including myself. When you look back, because this took its debut in 2017, about £1 billion shillings raised thus far, in excess of 500,000 accounts. How do you assess the performance of Akiba in terms of democratizing capital markets here?
So Akiba was an excellent idea, but I can say perhaps the execution was not as we could have liked it. So it was poorly executed, I must say, unfortunately. But it shows us the potential that we can be able to tap into small savings across the 40 or 50 million Kenyans who might be able to invest in small amounts, maybe $10 or $100 or $50, small amounts, 2,000 shillings. So it's a great idea in terms of democratizing, and they're giving the small savers an opportunity to invest in a relatively high yielding security that is also relatively secure, because government securities are generally very secure. They are risk-free in many markets. So if you give access to retail investors to access that market, I think it's a good way of diversifying, first of all, the investor base, as we talked about, and also giving them an opportunity to start making savings and contribute to the economic development of the country.
One of my friends, who I should tell you is the naysayers of the Akiba structuring, as it were, always argues that perhaps a lot more effort should have been dedicated towards structuring schemes to allow retail investors to come in through that, as opposed to trying to reach everyone, which I think just creates logistical hurdles.
The concept behind Akiba was to be able to reach millions of Kenyans to invest in small amounts. So that idea is not a bad idea. The problem is that the instrument they were buying is a complicated financial instrument. So not many retail investors will understand that. So I think what Akiba should have been structured more was like to be a savings product, so that investors who are putting in their 100 shillings or their 1,000 shillings get basically same kind of features as what they might get if they put money in a savings account in a bank. They don't need to understand the mechanics of how to trade a security that could be complicated, but just give them very simple options. You're investing 1,000, this is the interest rate that you get, and you get the interest rate, and if they wanted to exit, you give them an opportunity to exit without exposing them to what we call market risk or market movement of the securities.
It's been a couple of years ever since we had the green bond program being launched in this country. I think thus far, I could be wrong, you could correct me, we only have Akon, which has pursued that route.
Exactly.
How do you assess the uptake of this, and what do you envision as the medium-term outlook?
So the green bond market in Kenya is very nascent, as you said, but developing a market takes a lot of time. So you need to build an enabling environment. So remember, in Kenya, the NSC came up with listing requirements for green bonds. CMA also came up with issuing requirements for issuers who want to issue green bonds in the market. So that was done. And then, of course, the National Treasury and Parliament agreed to tax incentives for green investments, which is all very great as well. And then you have to now work on the pipeline of companies, potential issuers, encourage them to come to the market and raise money through green bonds. So I'd like to see, for example, Kenya coming to the market at some point, and others to come and raise money to invest in renewable energy in this country. And I'm very happy that Akon was one of the first to come to the market to show an example, to demonstrate that this market is viable. So going forward, I believe we have now the fundamentals right. Investors have been trained. issuers understand the benefits of issuing green bonds in the market, and I do hope that the market appetite is going to pick up for this market. And of course, I'm also looking forward to the Kenyan sovereign coming to the market and issuing a green bond, because that sets a benchmark for other issuers who may want to come to the market and issue on the back of that.
Maybe let's take a step back. When I look at Kenyan, for instance, and Kenyan has issued a bond before, which is deployed in geothermal exploration, which are green assets. How starkly different will it be if it comes this time? Why can't the previous issuances be deemed to have been green bonds?
Yeah, so there are two green bonds that you can have in the market. There's what we call labeled. So if it's labeled, it means it's gone through a process of labeling, and they are unlabeled. So what was issued by Kenyan before could potentially be called unlabeled green bond, because there was no label that was attached to that. The process of labeling basically starts by understanding the green bond framework. So Kenyan will come up and say, we're issuing a green bond because this fits with our strategy. This fits with our vision. So you're communicating to the investors why you want to come to the market. And then investors will want to know where is the money going to go? Which kind of projects are going to be funded through the proceeds? They also want to know how you select those projects. And they also want to know how you manage the funds that are received for those investments. And then finally, and most importantly, they want to understand the reporting requirements. How are you going to communicate to the investors to report to them on how you use the money that was raised from the green bond, what kind of projects were funded, and how do they change the life of Kenyans? Did they create more jobs? Did they reduce the cost of energy? Did they make the environment better? Did they improve the air quality that we are breathing in the country? So investors want to see the impacts of that, and I think that's the major difference that we have from the labeled green bonds compared to any other that might come to the market. So there's much greater transparency around those bonds.
I'm listening to you and wondering, if I have raised capital through a green bond issuance, how does the investor ensure I ring fence funds away from other investments just for green assets?
Yeah, so that basically speaks to that requirement I talked about, management of proceeds. So in many cases, you have to have or demonstrate to the investor that you have set up, robust structures for ring fencing the money. So in some cases, you might find you have a separate bank account where that money that is raised from the green bond goes in, and it's not commingled with the other assets that we may be having. So there are those kind of mechanisms. And then, of course, the reporting process that I talked about is one other process in which investors can be able to certify themselves that the money went to what you said it was going to finance.
Right, and that point by Dr. Osano takes us to a short break. We shall be right back with a lot more on this conversation where we are looking at how to democratize our capital markets. Stay tuned. Welcome back to this conversation on Business Redefined, where we are privileged to have Dr. Osano from FSD Africa, where he is the Director for Capital Markets. Welcome back on set.
Thank you very much.
Let's move away from fixed income for a while now. One of the latest developments, and which has really caused a lot of discussion in this market, is the issue of a share buyback. And NMG has set the precedent. I can tell you, I've spoken to a number of companies who have this option on the table. What's your assessment, looking at what just took place with NMG and as a market product, if I could call it, because it really is a way of rewarding shareholders, if I could say. What's your view? Because many people I talk to tell me this market has a valuation problem.
And I think it's probably right. The market has a valuation problem, so that it discourages companies from coming to the market and doing an IPO and raising fresh capital. Because when you're raising fresh capital, then you have to find the market value of the company. So if the market value is less than where you think it is, then the price at which you're going to raise the money will be much lower. So it kind of dilutes existing shareholders in the companies that might want to come to the market. So if you look at the market for the last 12 years, we've not really had a major IPO in the market. And that, I think, speaks a little bit to the valuation issue. But yet, when you look at the private equity market, there's been a lot of fundraising happening there. And there, perhaps it's much easier for companies to negotiate valuations with a small group of investors, private investors.
Where is the challenge? Because NSC would love to see a lot more listings coming on board. We just don't see them happening. What could be the factor which is, I mean, granted, the hype, or rather the acceleration we saw between 2005 to 2007 thereabout was because government was divesting stakes. And the question always is, should we always have to rely on the government divesting a stake to have a vibrant market?
Yeah.
How do we ensure now the private sector comes in aggressively into the listings?
Yeah, and it's a big challenge. Unfortunately, it doesn't have quick fixes. I see a lot of value in the public markets just because of the transparency that you get from the public markets. Companies issue annual reports that are made public. They publish their results in the newspapers, and everybody knows how these companies are performing. So there's much greater transparency. Even for the government, there's more taxes that are paid because if the company is transparent, everybody knows how much money the company is making, and the taxman too knows that. So there's a great transparency, and in fact, some studies that show, and this is for some other markets, the bulk of corporate taxes being paid in the country are coming from listed companies in the country. So there's an incentive actually to encourage more listings from a public good perspective. But then on the other hand, it's also a good opportunity for companies to be listed so that we have democratization of capital markets. Those are the investors. Citizens have an opportunity to have a say and a stake in the economic prospects of the country. But the issue of the valuation, I think that we talked about, is something that is probably a bit sticky, and we need to find ways of addressing that so that we can encourage more companies to come to the market. But we also need to be a bit more creative in terms of how we do business development, how we make outreach to unlisted companies that are relatively big and all that. And perhaps also maybe removing, I believe in my honest view, asymmetries in terms of requirements, disclosure requirements. In some markets, we have what we call public interest companies. So those are very important companies in the country, and they should be required to disclose as similar to a company that is listed in the market. And therefore, they might say, okay, there's no benefit of remaining private, let's go to the market and list. So for the very large companies that are of public interest, I think we should encourage more disclosure, which hopefully will encourage them to come to the market. But for the other companies that are relatively smaller, I think we have to make a value proposition to them. Because those companies have to make very hard decisions in terms of, I'm looking for capital. Where can I get the cheapest source of capital? And we have to address that. If we can't address that problem, we're not likely to see companies coming to list. They have to see a value proposition of listing in the market. But one other thing that I've seen also is that even though we have not had very many IPOs in the market, companies that actually tend to list in the market get it easier to raise additional capital. So even though the IPO market is dry, we have seen a lot of rights issues. We've had secondary offerings and all that in the market, which has raised much more money than the initial public offerings and all that. So there are benefits that can be demonstrated to these companies that are not there in the market in terms of how being listed might reduce their funding costs into the future.
I've spoken to a few players in the private sector, and they'll tell you, why would I go through the IPO process, so many disclosures, when in the private market, there's so much hand-holding, so much due diligence. I really feel like I'm being taken care of. And I don't have to do all these disclosures. Do you think the private equity market is stealing the thunder from the public market?
Well, I can't really say it's stealing the thunder. So I look at the private equity market as an alternative, a complementary source of financing. And remember, we talked about if I'm a captain of industry, I'm a shareholder in a company, and I want to expand, I have to make a very hard decision in terms of where can I get the best source of capital, maybe in terms of terms, maybe in terms of cost, those kind of things. I have to make all those and valuations as well. So I have to make those very hard decisions. So in a sense, we have to make it compelling for a company that may want to go to the private market to consider coming to the public markets. And in some cases, and we've seen this in bigger markets, investments in private equity tend to sometimes have an exit through the public markets. We haven't seen a lot of that happening, but we do hope that will happen as well. But we also have to think of working on disclosure requirements as well, so that we remove the unbalanced nature of the disclosure requirements between the markets, so that investors don't ultimately make decisions on their funding, decisions around disclosures. It should be other considerations that they may need to consider. In
2013, the growth enterprise market segment was launched. And the whole idea was to catalyze the appetite from small and medium-sized businesses to come into the market. it doesn't seem to have really worked well.
Yeah.
What's your assessment of this, and what could really be the underlying reason here?
Yeah, so the idea, again, excellent idea. Unfortunately, when you look at globally, SME exchanges have generally had challenges for a number of structural reasons, mostly to touch with investors. So if I'm a large pension fund manager and there's a small company coming to the market, I might not be able to invest, even though I believe very strongly about the prospects of that company, because the liquidity or the float that is available is too small to make a difference to my investments. So that's a fundamental problem that has to be addressed. And so I think we need to start thinking about alternative approaches of giving access to capital to the SMEs. And one of those approaches could be having a listed SME fund. So how that could work is that you have a fund, a vehicle that is listed in the market, and we have investors in the vehicle, could be pension fund investors, insurance companies, retail investors in the vehicle. Then that vehicle makes investments into the smaller companies and all that, and then manages, provides the hand-holding support that you mentioned as well. And then, of course, within that portfolio, if those companies become big on their own, they can come to the market and list subsequently. So that's
more like exits. More like the company.
More like an exit. So that means they have been nurtured over time. They've been acclimatized on disclosures. They have been taught how to engage with the investors and all those kind of things. And perhaps they have been given an opportunity to grow, to become reasonably big, and therefore have the ability to raise large amounts of capital in the market on their own. So having that kind of vehicle, perhaps, I think will be quite transformative in the market in that sense, because it addresses some of those fundamental, challenges I mentioned about.
Collective investment schemes,
yes,
increasingly gaining traction in this market,
yes,
and still many people don't understand how they work, how they're structured, etc., the risks involved in this. Yeah. What's your assessment of the lay of the land, how it's moving, and the uptake?
Yeah, so the uptake of collective investment schemes has actually increased quite significantly over the last maybe 3 years, but it's increasing from a very, very low base. Yeah. So we are talking about maybe 115 billion shillings in collective investment schemes. That's a very small number relative to the size of the capital market that we have. And within that landscape, about 90% of those schemes are money market funds, which is good because they speak to the risk appetite of the investors. And it also shows that there is a strong growth potential, because if investors can convert their savings within the banking system, which are not necessarily generating very high returns, to money market instruments that are secure, that give a better return, that are liquid as well. So you can see the potential is quite huge. But we also have to address a number of regulatory issues to make the regulatory environment a little bit more favorable, and also address issues of confidence in the market as well, so that when investors are moving their money across from either at home or from the banks, they are confident that the assets are going to be secure, and they can get access to those assets when they need to get the assets when they need to do so.
There has been talk about structuring vehicles which would allow the pension funds, which are sitting in 1.4 trillion shillings of assets under management, yeah, into vehicles like government projects, especially with things like the Big Four housing agenda and what have you. Speak to us about possibly how this can be restructured and what opportunities exist.
So Africa is the fastest urbanizing continent, globally. I think by 2015 already we said about 50% of Africans were living in cities. The Kenya urbanization level is about 28%, but that is projected to rise to 46% by 2050, or 50%. So by 2050, half of Kenyans will be living in urban areas. In terms of numbers, we are currently 44 million Kenyans will be living in urban areas. So it means we have to think about that problem, because if we don't plan for that, we'll end up with a situation where a lot of Kenyans and Africans, as we know, are living in informal settlement, 60%. So there's something we call the urbanization dividend. So if you plan to have, for example, what we call compact cities, so smaller cities that are concentrated, cleaner cities, so we are looking at the problem of pollution. You're also looking at connectedness, how people living in the cities commute, move from one distance to the next, how resilient those cities are to climate change and all that. We can create an economic opportunity, or the urbanization dividend that I mentioned about. So in the study that we conducted, we found projects in Kenya that will cost about $27 billion, equivalent over the next 40 years. And they are likely to generate economic benefits of about $140 billion for the Kenyan economy. So that's massive. So it's a no-brainer in many ways. And that's not considering the fact that if we have better cities, cleaner cities, more compact cities, connected cities, the quality of life improves. Healthcare costs decrease because people get sick less often because they're not breathing a very polluted air and all that. So it's something that potentially can be a very strong catalyst for economic development, and the capital markets again can play a very strong role in financing that growth, either through the green bonds or through affordable housing investments and many other instruments that can be put in place to support that investment.
Unfortunately, that point takes us to the close of our conversation with Dr. Ivan Susano, the Director for Capital Markets at FSD Africa. We have looked at a range of issues, right from the fixed income to the equities, which are the shares, and also larger policy issues around urbanization and the opportunities for financing being created. We shall continue covering more of these issues on Business Redefined.